So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to The Daily Call. On today's call today, we are going to tackle the topic of trading options with technical analysis. Now, I wouldn't say that this is by far the most requested topic or a big topic that we get a lot of questions on, but it's definitely up there. I think that people often find technical analysis first because they start their journey with stock trading. They learn a little bit about technicals. They think it's some magic pill to kind of solve all their issues with directional trading. And then eventually maybe they transition to options trading, and they think that the married combination of this is the holy grail, basically. And obviously that's not the case, right? So we know that, nothing is a surefire thing. It's all high probability. It's all based on math. But the way that I think about, trading options with technicals, I think about technicals first as I'll talk about it first in this call because I think it's important to cover. We did a lot of research in our signals report that basically I know now and have known for a while, that most technical analysis indicators are practically garbage. 95, 96% of what we tested, which was thousands of variations, really don't work. They're not predictive in their alerts. And when they are predictive, they're not consistent in actually delivering like a turn in, the actual market that justifies the premium and the stock trade, et cetera. So they don't actually generate enough positive signals that make money to counteract the negative signals that lose money, right? And so that being said, it's not about actually using one particular indicator versus another. It's actually settings within each indicator. So I often think about it as you have to use the right settings for the right environment, basically. So I related to maybe running outside is fine, but trying to run at the bottom of a pool, not going to work. That doesn't mean that running is bad. It just means that running outside is better than running at the bottom of a pool where you're not really going to get anywhere. And so I think you have to kind of realize that first off. When I think about then using technicals for trading, I know that there's indicators that work well. They're not amazing, so let's get that out of the way. They're not amazing, but we're talking 60, 65% chance of success, have a very good likelihood of, seeing the stock stop or turn around, lose its momentum, etc. Not always just do like a V bottom, V top, etc., but has a pretty good indication of, the stock turning around. So when I think about that, I layer on top of that now options trading. So if I know that I have a technical indicator that's just based on the stock price, right, has nothing to do with the options yet, and it has, 60, 65% chance of being successful long-term, of seeing a, turn the stock or, roll over in the stock, whatever it is. If I can layer on top of that trading options and then also give myself a margin for error, that's where I think that, the power of trading options with technicals comes in. So let's say that a stock is trading at $50 and now we get a technical buy signal. Well, I'm not going to buy the stock at $50. I might sell a put credit spread at, the 45 strike and buy the 40 strike. So I'm still giving myself a $5 margin of error. I got a technical signal maybe that the stock was turning around or that could be, forming a bottom here, but I'm not going to trust that as the only thing that's going to happen and stick my flag in the sand and say, okay, $50 is the line in the sand. It's not going below there because that's not realistic. So what I will do instead is I'll give myself a margin of error by selling the 45-40 credit put spread. And so I've got a $5 buffer. So if I'm wrong, or if the technicals are wrong in this case, I still have the opportunity then to possibly make money trading just the options by giving myself a $5 cushion to allow the stock to fall and still make money. So hopefully that concept makes sense. And again, it's something that I use often in our trading. Now, the way that we have our technical signals set up, which you can learn more about at optionalpha.com/signals, the way that we have them set up, we don't generate signals that often. So it's not a daily, it's not an intraday thing. I mean, we may generate like a signal or two every month or, like a handful of signals every month for the different securities that we follow. And that's good because we found that actually works out really well. We've traded a lot of these signals and they help us make decisions about trades that we're getting into. Also, they help us make decisions about trades that we currently have that we consider rolling from one month to the next. In fact, we recently did a trade in SLV, which probably by the time this podcast goes live, that video will be up publicly on YouTube, so you can check it out. It's a big case study that we did in SLV, where we used the technical signals to determine whether we wanted to continue to maintain the contract from 1 month to the next. So before we actually rolled the contracts, we looked at the technicals and we said, okay, Are the technicals suggesting that this stock is going to continue on this path, or do we have at least a better assumption than not that it might actually roll over? And so we thought it might actually roll over. We continued the trade for the next month. So we basically, took the loser that we could have had and closed, and we carried it in duration and held it a little bit longer. And it actually ended up turning out to be a $312 winner. So it was a really good trade. And again, we wouldn't have done that had we not, at least glanced at the technicals. Now, before I kind of close this out, again, the key for me, though, is that the technicals are not the first thing I look at. You don't necessarily need to use them. Do I think that they have been helpful in how we make, some of our decisions? Absolutely. But it's not the foundation of what you should do. You should definitely still trade high probability. It should all be balanced. So even if I got, for example, a technical buy signal on something, I would not go long that stock if my portfolio already had 10 long securities. So I wouldn't make that decision. So I think you have to kind of take this with a grain of salt, as with everything, I guess, with investing. But it's something that we definitely do use often and do check. It's just not the most important factor in our decision. So again, if you guys want to learn more about the research that we did and all the back testing, head on over to optionalpha.com/signals. Again, that's optionalpha.com/signals. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from optionalpha.com.